Mihir Vora now joins us. Mihir, good morning. What's the sense that you get in terms of valuations? How would you look at valuations in the current scenario where EPS downgrades, what happened to FY17 is quite uncertain. So would you shift ahead and start to look at FY18 numbers where probably you can predict with a little more certainty?
Yes, absolutely. Well, a lot of stocks have come down quite a lot, but as you rightly said, we don't know the extent of earnings downgrades that will happen in the third and fourth quarter of FY17. But the fact remains that, apart from valuations, what we do need to take a call on is how swift the recovery will be after this impact of demonetization. So whether it will be a sharp V recovery or elongated U recovery is something that we'll come to know in the next 3 to 4 weeks as we see incremental data points on various business segments. So I'm not too worried about valuations because stocks have come down, markets have come down significantly. But more importantly, I think it's the relevant thing to talk about is to understand the shape of the recovery.
Right. So what do you do if you're an investor right now sitting on a little bit of cash? You start to put some money into the markets?
Absolutely. So some of the sectors which are linked to consumption, etc., have to be resilient, and you might see a dip in November and December numbers, but by February, March, you will begin to see a recovery in some of those numbers. So the billion plus people that we have, the consumption story is something that definitely is going to be there for a long time, and some of the good quality stocks in the auto segment, in the FMCG segment, etc., if they continue to go down the way they are, they will become buys very soon, I would say.
Right. In terms of, dollar index, what's happening into US, some of the investors also seem to be worried about that. If dollar index goes up, you think it's only a tactical play, but otherwise it's not a big worry for the Indian markets?
No, it is a worry, I would say. The whole risk on, risk off theme to a great extent is linked to the strength of the US dollar. And since the election result in the US, you have seen a structural change in the behavior of the global markets. After a long time, we are seeing the dollar strengthen, the US bond markets beginning to correct, and because of that, we are beginning to see a large shift to the equity markets in the US. So after a long time, the US looks like the growth engine, and it's such a large market that it can suck away a lot of asset allocation from the rest of the markets, including emerging markets like India. We also are not seeing very positive data points from China, especially on the currency side and the fixed income market side. You are beginning to see some kind of a liquidity squeeze in the Chinese markets. So there are a lot of global moving parts which we need to be wary about.
Right. And that can lead to a risk-off session considering the dollar index is going up, crude is going up. So probably India may again start to look a little expensive.
As I said, it's not really about valuations, it's just the way flows are going to move. And in a risk-off environment, valuations don't matter. It's basically the direction of flows that matter. Fortunately, in India, we have seen a significant local asset allocation coming to equities, if we just talk about the equity markets. And that's the reason why we have seen the markets holding the way they are. With the lack of local flows, the markets probably would have been much lower.
Right. In terms of, what can happen to the market, say if Fed was to hike fast, it'll more be with what sort of environment are we in, whether we are in risk off or risk on. If it's still risk on trade, probably the downside may be limited.
Yes, fortunately, as I said, the Indian local investor seems to be holding on, the retail as well as the bulk investors so far. They have not given up on India. And again, fortunately, India is amongst the few markets in the world or economies in the world where interest rates still have scope to go down. The pace of decrease in interest rates may vary depending on the global and the local situation on inflation, etc. But structurally, even over the next 12 months, we should see interest rates in India still continue to go down as they have in the last 1.5 years. So to that extent, I think India is different from the rest of the world. But in a completely risk-off environment, probably we cannot be insulated in the short term. But the long-term story will remain intact, especially since we have done a lot to fix our fiscal deficit, our current account deficit, and that's going to help us in the long term.
Right. Suppose if the rupee were to depreciate, Do you think actually it will have a positive impact on earnings? Because pharma may start to look attractive, IT may start to do well. Some of the companies like Reliance, which have a big export, may actually deliver good numbers.
Yes, a significant component of the large indices like Nifty and Sensex is composed of these outward-looking sectors linked to the global commodities and to the currency, like you mentioned in IT and pharma. So that will help, of course, in corporate earnings, but that necessarily would not help the Indian economy per se, because as we realize, we are still net importers of a lot of things, especially high value things like electronics, crude, like gold. So to that extent, as a country, we would not benefit if the rupee were to depreciate. And in the long term, if the currency continues to depreciate, it also feeds into inflation as far as the local economy is concerned. So yes, while you might have a bump up in the corporate earnings for a year or so, I would still prefer a stable currency than a weaker currency.
Right. So, the near-term environment seems to be uncertain. Let's talk about FY18 or probably second half of FY18. Do you think the downgrades over there may be meaningfully less because things may normalize as circulation of currency happens? Maybe we'll get a couple of more Fed data, what happens to dollar index. So things would get stable going into second half of FY18. On that basis, earnings downgrade will be limited?
That's what it looks like. So what will happen that there will be larger downgrades for FY17 and smaller downgrades for FY18. So on a year-on-year basis, you might see actually an upgrade in FY18 percentage growth numbers, so to say, because as I said, while probably for FY17 you might see at the Nifty level so far about a 3 to 5% downgrade, you might only see a 2 to 3% downgrade for FY18. So in a percentage growth basis, FY18 probably maybe actually upgraded a little.
Right. In terms of allocation, how would you look at the 10-year rate right now and probably the rate that SBI is offering at? The gap is the highest since second half of 2008. What does that essentially mean? Both equity and debt are not looking attractive, or the rates or the transmission has to happen in the economy?
So the short-term rates that we are seeing are temporary, I would say. That's because of the deluge of liquidity that we saw in the aftermath of demonetization, as a record amount of cash was plowed back into the banking system. But this is going to go away as remonetization happens. So it's a temporary thing. I don't think these extremely low rates at the short end, 1 month to 1 year kind of range, are going to sustain, and they will rebound in the coming 1 month or so.
Right. How would you go ahead and look at?
Sorry.
No, Mihir, go ahead.
Overall, as we discussed, we do expect. Yeah. So overall, as we discussed, we do expect the 10-year bond yields to still come down further over the next 1 year, which makes even fixed income an attractive option.
Right. In terms of the budget, it's expected in the first week of Feb now, and probably this earnings is something which everybody has discounted, that there will be a lot of volatile movements for a lot of companies in terms of earnings. So in terms of run up to a budget, how would you look? Do you expect this budget to be announce a lot of measures? It could also be expansionary rather than just controlling on the fiscal side?
Yes, it should be. I don't know whether they will want to optically show a higher fiscal deficit because that has other implications in terms of our sovereign rating, etc. But it should be a budget in which there is significant goodies for the masses who have suffered a lot in the demonetization process. So the government will, I suppose, have a thrust of a bit of a rural infrastructure, rural housing, mass housing, etc., and of course continuing with the other schemes at the social level, making a lot more use of the Aadhaar card and the Jan Dhan accounts, so to say. So I do see a bit of tilt towards the rural population and the tier 2, tier 3 population who have suffered quite a lot in this process and would obviously want to see tangible benefits. A lot depends, of course, on the success of the income disclosure scheme and the steps that the government is the other steps that the government is taking to identify black money and gather some more tax revenues out of that. So I think with a decent kitty, depending on how successful this whole scheme is, you should see a lot more flexibility for the government to spend on things like rural roads, rural housing, mass housing, low-income housing and those kind of projects. The other projects like the road building, etc., railways, capex, etc., which were targeted to be strong in any case, will anyway continue.
Right. In terms of digital payments, we've already seen a lot of benefits coming in, or incentive moves coming in for digital payment. Do you expect digital to be one of the big growing sectors? As of now, there are limited opportunities, but still a lot of companies can be played via the digital method. Are you looking at them?
So we're trying to see. We haven't found anything yet, frankly, and obviously that's one of the segments which is going to grow fast. And a lot of it is embedded within some of the listed companies in a small way. Most of the banks have their own gateways and their payment systems, and most of the independent systems are actually not listed and probably funded a lot by private equity and venture capital. So in the listed space, there is nothing that we see directly so far which we can play as far as the digital payments is concerned. But as a segment, you're right, it will be one of the exponentially growing segments over the next few years.
Right. So, you mentioned about banks, the wallets over there, probably the digital focus that banks will have now. Do you think it could be a meaningful contributor in some time to these banking names? Because now the focus will shift towards digital and e-payments where banks could benefit. So for some of the private banks which are very ahead into digital versus their peers, that is probably something that you would want to see and start to ascribe a value in their SOTP basis?
It may be a bit early to do that because the whole focus is to deliver it at a very low cost. So I doubt whether the regulators and the government would like banks to make a killing out of these, because the first priority is to get the penetration up and going rather than talk about profitability. Profitability may come a few years later. But I think the first priority should be to offer these services at a very low cost, very low transaction cost, and make sure that the penetration goes up exponentially, and then talk about profitability. So in terms of SOTP, etc., for some of the banks that we talked about, I don't think it makes a material difference at this point in time.
A lot of banks are getting a lot of liquidity, CASA is going up, rates are coming down. But at the same time, opportunities for loan also seem to be getting very, very limited after demonetization. Do you think it's a very temporary sort of blip for these banks, and you expect it to become normal and this liquidity will start to be put at efficient use in some time? So you're not worried as a financial investor about the loan growth?
No, it is a source of concern. Talking about on the deposit side, as we discussed, this excess liquidity is going to be drawn down obviously as remonetization happens in the system. So the excess liquidity over the next 1 or 2 months will start reducing in any case, and short-term interest rates will start to move up from the very low levels that we are seeing currently. So that's on the deposits and liquidity side. On the loan growth side, it's really a function of the shape of the recovery, as we discussed in the beginning of the program. Whether it's a sharp V or a elongated U, that will determine how fast the credit growth happens. But as of now, it looks like credit growth is slowing down, both for the public sector and the private sector banks. And probably a month or two is what it will take for credit growth to come back into the system at the minimum.
So earlier, even NBFCs were quite in focus. Rates will come down. People have trust on NBFC. Their loan book is quite clean. But now, do you think NBFCs, there is a big question mark? So banks are looking better placed than NBFCs?
I'd say both have their individual segments. On the positive side for NBFCs, their cost of borrowing structurally is coming down. And of course, they are better placed to play the consumption theme, so to say, because of their nimble basis and high margins, so to say. But given this, this completely different or unique event that we have seen, we still don't have enough data points to judge how the credit quality of the book is panning out. So whether it's on the loan against property book or the personal loan book or the microfinance book, we still really don't have a clue as to how good or bad the situation is on the credit side. So on the NBFCs, I would first take a call on the quality of the book over the next month or two, and growth will come. I mean, lending is not a problem. The segments they are working in are highly underpenetrated. So growth is never a problem in these segments. We need to take a call on the credit quality.
We just spoke to M&M Finance a couple of days back, and they are saying that Q3 and Q4 is very uncertain. They don't know how things would recover. However, the inquiry levels have gone up. People have started to use digital methods, whoever could, in terms of repayment. So, you would just wait and watch as an investor, or some of these names have done excellent over the last, 5-6 years. So investors should actually go ahead and book profits.
Well, some of them have corrected 20, 30, even more percent, over the last few months. So, in terms of valuations, they have come to attractive levels. But as I said, one would rather see the impact on the credit quality, on the asset quality of the overall book. Because this is an event where nobody has any experience in. So, I can't take the company management at face value or even any sell-side analyst at face value. One will really have to take a much more granular look at each and every company, because again, the business models of different companies are different. Some have more exposure to mortgages, some are more into loan against property, some are more into microfinance, some are more into personal finance and consumer durable financing. So each segment is likely to, and of course rural financing also. So each segment is likely to behave differently. So one cannot take a broad brush view on the NBFC segment as a whole. It will have to be a company by company analysis.
Right, just about microfinance, their ticket size was small, mainly operating into cash and very, very rural areas where, banking facilities may not be quite sufficient at this point of time. That is something which does warrant a derating?
So, we are getting mixed signals there. Some of the companies have shown a rebound in collections quite sharply. Some of in other companies, the rebound is a bit slower. So again, it's going to be a function of how diversified the business models are, what geographical segments are facing the stresses. There are some politicians trying to foment some kind of a payment holiday kind of a situation in some of the cases. So again, we have so many companies with different business models geographically as well as vertically. Some are more urban, some are more rural. So even within the microfinance space, we'll have to take a company by company call rather than making a broad brush statement.
Right. In terms of in terms of rural areas, the earlier point in June, July was that rains would have a positive impact on rural areas. We had the pay commission that will come in. Plus, the growth into rural areas was not there for last 3 years. So there'll be a base effect which will lead to high growth. But as of now, via tractors, via some of the other plays except MFIs, would you still want to play the rural story?
So that's the fact that the summer crop has been decent, the winter crop sowing has been decent again. So that story continues. That plus the fact that we have the 7th pay commission, monies being rolled out as we speak. So that thing was always there. We don't know the one-time impact of this demonetization thing, and whether it's likely to result in an immediate rebound or it's going to be an elongated rebound. So that is at this point a difficult call to take. Though high quality companies which have corrected 20, 30, 40% in some cases, do deserve a look, and it may be time to start at least nibbling at some of these ideas.
Right. In terms of one new sector where we have seen a lot of deals has been the insurance space. So we saw ICICI Pru listing. We saw a big SBI Life deal earlier. We've seen a deal between HDFC and Max. Do you think insurance as a sector is something which the market is not owning right now? So that could be big, and plus it's a very underpenetrated area. So the growth could be quite large.
Yes, definitely. Because as you rightly mentioned, most of even now as we speak, the market share is still with the bulk of the market. Excuse me. A bulk of the market share is still with the public sector companies, and the private sector still has a long way to go in terms of growth. And the kind of work that needs to be done as far as actual selling, this is a very actively sold product. The kind of hard work that needs to be done in active selling, getting new people into the system. So that structural story, not only for insurance but even other products like banking services, mutual funds, etc., remains a long term story, because people are still completely invested in real estate and gold as far as India is concerned, and the awareness or the propensity to invest in financial assets has traditionally been very low. But now with real estate looking very shaky, Gold also hasn't given any returns in the last few years. We are seeing a shift towards the financial assets, including insurance, mutual funds, etc. So I think this story will continue for a long time. And as people start making money in financial assets, I think it's going to be a virtuous cycle where we see more and more growth in these segments.
Right, and with demonetization coming in, focus towards banking systems, actually mutual funds, insurance become much more attractive than buying a physical asset?
Absolutely, because again, physical assets have the limitation of liquidity and the fact that we are coming off from very high levels in terms of absolute valuations as far as physical assets are concerned. So it's going to take a long time for physical assets to give the kind of returns that they gave, say, 5 years back or 7 years back. And the fact that we have a structurally, low inflation scenario as far as India is concerned, the RBI and the government are targeting inflation means that interest rates are going to be lower and lower, which means the financial assets should do quite well, especially equities, which thrive in a low interest rate scenario. So I would say that the culture of equity coming back as far as India is concerned, and we have seen that over the last couple of years. We have seen a systematic increase in collections for insurance companies, for mutual funds on a monthly basis, and it's only accelerating. So even in a bad market, in a bad month like November, mutual fund flows, insurance company flows were very, very robust. So I think that gradual long-term confidence in the financial assets is being built up as far as the retail investor is concerned.
Right. Let's talk about infrastructure space and how would you approach that sector now? Till now, retail loans, focus on retail companies were doing well. With demonetization, a lot of organized business will start to pick up. A lot of organized business, once we have the currency issue behind us, would start to do well. Would you start to look at corporate capex, maybe mid-sized companies within infra? There are a lot of sectors, but would you look at it actively now?
See, infrastructure as a segment, frankly, has disappointed us. We were quite bullish a couple of years back with the new government coming in. We expected a lot more accelerated activity, but that has not happened as far as the private sector is concerned. On the government side, yes, a lot has been done, and the government over the last couple of years, even in this year's budget, has earmarked a decent amount for railways, for other infrastructure projects, etc. So, unfortunately, the private sector is likely to take a lot more time to pick up, especially with the rollout of the GST coming in. Probably managements will be more busy trying to set their GST systems in place over the next 6 months than to plan out massive capex. So for the next 6 months at least, I see it still is likely to be a government-driven story rather than a private sector-driven story.
Right, but within infra, what do you like? So, within infra, there are a lot of sectors. You like ports, you like roads, you like defense, maybe capital good companies, power companies.
So within infra, our preference has for a while only been in the providers of services to these infra assets. We don't like asset heavy models because those are directly or indirectly regulated as far as returns are concerned. So you can't expect compounded kind of growth. You maybe expect utility kind of returns from these segments. It's in the construction companies, the EPC companies, the design companies, and to a certain extent in capital good companies that you can see compounded growth as you see increased infra. So we'd rather play it through the construction companies which are still surviving and still have healthy balance sheets to execute the order book that is likely to be rolled out.
Right. How would you look at pharma, with all the noise around pricing, with all the noise around what's happening into US generics? You would just wait and watch for a couple of investigation reports rather than, saying that a pharma stock, a good generic pharma stock has fallen 10%, valuations are attractive and one should buy?
Pharma is again very granular. Each company has different products, product pipelines, geographical segments. But in general, US, which is the largest market for the segment, has been a bit hostile over the last few years. The FDA especially has become very strict. Rightly so, I would say. We do need to measure up to global standards of manufacturing good practices. So I think that's a learning curve for the pharma sector. The inherent strengths remain. The managements are strong. The manufacturing capacities are strong. But the last couple of years have shown us that there were some slacknesses, loopholes that we tried to exploit, and those are being plugged. So I would say if you were to ask me for a 3-year view, I am very bullish on the segment. But the next 6 to 12 months is probably a little bit more volatile, not only because of the FDA issues that are still hanging, but also because of the fact that the new regime in the US seems to be more favored towards driving down healthcare costs, drug prices, etc. And once the new president takes oath on January 20th, we need to see further directions as far as the healthcare policies are concerned. So I would rather wait and watch, see the incremental policy initiatives by the new regime, and then take a call on the Indian pharma segment.
Right, but as you said that US FDA has been strict, but you think a lot of companies have started to adjust, so we are seeing clearances coming in for a lot of plants which were not expected to happen. Some plants are seeing clearances sooner than what was expected. So all of that you think is, at least we can say that Indian pharma is moving in the right direction?
Absolutely. So a lot of improvement has already happened, as you rightly said, and approvals are coming. Second, third inspections have happened and are being cleared. So one would again not make a broad brush statement. Company by company, there are good companies which have already done the right things and on their way to growth, so to say. Only thing remaining is the policy initiatives of the new regime in the US.
Right, and in terms of pharma valuation, how would you look at it? You think valuations are still expensive because earnings outlook is bleak? Once that change, it would start to look very cheap?
No, again, see, these are depressed earnings because of one-time factors in certain cases. One time has, in certain cases, lasted for more than 1 year. But still, these are not likely to be long-term recurring issues. Turnovers have dropped because certain plants have been shut, etc. So I would say those capacities are still there, the software is still there, the manpower, the skill set is still there, and the products are still there. They just have to launch it with the right processes and with the right certification. So I would not look at earnings in this scenario. I would look at the absolute valuations in terms of market cap, how much has the market cap fallen from the peak, and versus its earnings potential, which was there say 2 years back, 3 years back, and then look at those companies. So I would say that good quality companies which have now fixed their ways but still have depressed earnings should not be looked at in PE terms, but rather the potential terms.
Right. Just I wanted to ask about, can it give similar returns like what IT has done after November 9th? So if you look at the IT index since November 9th, it's given returns of around 9%. So, any sort of positive news, dollar index is going up, margins will go up. Probably US would see spending. Any positive news? And even pharma could give similar sort of returns?
Yes, in fact, I would say that potentially pharma can, over the next 3 to 5 years, give higher returns than even IT. Because in IT, we seem to be hitting a demand wall. Structurally, growth rates are coming down. And of course, you have the other headwinds of further tightening of H1B, etc., issuances by the new regime. And pharma still hasn't done too much as a sector. So I would say if you look at a 3-year view, probably pharma has a far more way to go.
Right. And in terms of IT, after the recent run-up and with dollar index going up, probably US recovering, you would be bullish, tactically bullish on IT?
See, in IT, I'm very wary of playing the currency game because that does not really give you the visibility of volumes. Currency can give you a one-time upside, but those are not likely to be repeated every year. I don't think you will see the rupee depreciate every year, so to say. One should focus on the long term, which is volume growth, and that's where we see IT as a segment is faltering. We are, probably talking about low double-digit kind of a growth for the industry against the 20s and 30s that we are used to seeing. So to that extent, IT as a segment is at best a market performer at this point in time.
Even the mid-cap IT?
See, in mid-cap IT, it has to be, looked at it like the pharma stocks we talked about, product by product, business model by business model, because these are not, 20, 30,000 employee companies. These are companies dealing in certain niche products or niche segments. And we have to analyze each company separately rather than making a broad statement on mid-cap IT companies.
Right. Just a word on oil marketing companies. They have been one of the best beneficiaries. We cannot speculate whether there will be price hike of diesel, petrol or not, or what magnitude it can be. But going ahead, they have structurally become positive. They have solved out their balance sheet issues. Maybe 1 month issue here and there. You would not be worried as an investor?
Absolutely. I think OMCs are still reasonable in terms of valuations, and there is decent visibility of growth. So to that extent, I think these companies have now come out of the woods, and as long as it's a broadly hands-off approach to pricing from the government, these companies should deliver decent returns because valuations are still not expensive.
Mihir, thank you so much for taking out time for us. Always a pleasure.